In March of this year, the TSP fund dropped nearly 5% in a single month. The S fund dropped over 4.5%, and the I fund fell over 9%. So if you had 400,000 in the C fund at the start of March, you had roughly 380,000 by the end of it. And that was before the additional tariff-driven sell-off that hit the first week of April. And if you had money in the life cycle funds, you got hit too. The L2050 through L2075 funds dropped over 6% in March alone. Aggressive allocations, the ones that most veterans under 50 are in, took the worst damage. And what was the advice? The same thing it always is. Stay the course. Don't panic. It'll come back. Maybe it will. Maybe it already has by the time you're watching this, but that's not the point. The point is that your retirement savings were fully exposed to a geopolitical crisis that you had no control over. And the only plan that anyone had for that was just to hope that the market recovered before you needed the money. So I'm Dan Farnsworth, retired naval officer, 23 years of service, and founder of Victory X Financial. And I want to show you why this keeps happening to your TSP and a structure where it literally cannot happen. So March 2026 wasn't just an anomaly, it was the latest entry in a pattern that has been repeating for as long as the TSP has existed. In 2000, 2001, 2002, the stock market dropped 3 years in a row, and the S&P 500 lost roughly 40% of its value over that stretch. So veterans with C fund heavy allocations, they watched years of savings just boom, evaporate. And then in 2008, that same C fund dropped over 38% in a single year. So if you had 300,000 in the C fund at the start of 2008, you had roughly 186,000 by December. So 114,000 just gone. And here's what people forget. A 38% loss requires a 61% gain just to get back to even. And the S&P didn't fully recover until 2013, so 5 years of your retirement timeline were just burned getting back to zero. Not ahead, but zero. Now in 2022, the C fund dropped over 18% and the S fund dropped over 26%. So veterans that were planning to retire that year faced a brutal choice. Either retire with a diminished portfolio or just keep working and hope it recovered. And now here we are, 2026. The C fund was down nearly 5% in a single month, and the I fund was down over 9%. All driven by a conflict that was halfway around the world that no TSP allocation strategy could have predicted or prevented. That's 4 major hits in the last 6 years alone. And every single time the advice was the same, stay the course. Well, let me ask you something. If your vehicle broke down 4 times in 6 years and the mechanic's only advice was keep driving it, would you keep listening to that mechanic or would you get a different vehicle? And here's what most veterans don't fully understand about their TSP. When your money is in the C, the S, or the I fund, you are directly invested in the stock market. So you own the shares. And those shares go up when the market goes up, and when the market drops, those shares lose value and there's no floor. So there's no protection, right? There's no mechanism that stops the bleeding. The G fund is the only TSP fund that's mostly safe, but the G fund only pays about 3 to 4%. And after inflation, your money is barely growing. It's a parking lot. It's not a growth vehicle. So veterans face a choice inside the TSP that is, well, fundamentally unfair. Either accept real market risk with no downside protection or accept returns that barely keep up with inflation. Growth or safety? Pick one. And now here's why that matters most when you're within 10 to let's say 15 years of retirement, because recovery time is finite. If you're 30 and the market crashes, you got probably 30 years to recover, so you're fine. That math works. But if you're 52 and the C fund drops, let's say 30%, you need approximately 4 to 5 years of strong gains just to get back to where you were. And during those recovery years, you're not growing wealth, you're just digging out of a hole. Now, if you're 60 and the crash hits, you might not recover at all before you need the money. So you either retire with significantly less or, well, you just keep working. And if you're already retired and now you're withdrawing, the damage is catastrophic because you're pulling income from a shrinking balance, and that's called sequence of returns risk. It's the number one reason that retirees run out of money even when their long-term averages look fine on paper. Now, the 2026 drop was modest compared to 2008, but it doesn't need to be 2008 to hurt you. A 10% drop at 60 while you're withdrawing, let's say 4% a year for income, can permanently alter your retirement trajectory. But what if there was a structure where your retirement savings could participate in market growth, but never go backwards in a crash? Well, that structure exists, and it's what we build for veterans at Victory X Financial. It's called a market-protected indexing strategy. And here's how it works. So your money is moved through a tax-deferred rollover from your TSP. So there's no taxes due on the transfer. There's no out-of-pocket costs. And we move it into a structure that's linked to market indexes like the S&P 500 and the NASDAQ. But it's linked. It's not invested, and that's the critical decision. So when the index goes up, let's say 15%, your account is credited with growth. And in many structures, you're participating at very high rates with no cap on the earnings whatsoever. And you might also even receive upfront premium bonuses that can help accelerate your growth in the early years. And then when the market drops, like March of 26 or 2022 or 2008, whenever, right, your account is just simply credited with zero. So it's not -5, it's not -38, okay? It's just zero, and your principal doesn't go backwards. Your previous gains are locked in, so the crash basically happens around your money, not to it. And because of that downside protection, the income math changes completely. Now, traditional advisors will tell you to withdraw no more than 4% per year from your TSP because the account is so exposed to loss. But these strategies can guarantee 7, 8, even 9% or more per year in retirement income, and that's for life because the risk that forced the 4% speed limit has been structurally eliminated. And there are no annual management fees in many of these designs, so no out-of-pocket costs and income for both spouses for life. And you still have access to your remaining balance, which also continues to receive annual index credits even during the income phase. This is not about beating the market. It's about refusing to let the market destroy what you've built. And let me show you what this looks like with real numbers. So let's say we have a veteran couple. They're age 45, okay? They recently retired from the service, and they have $200,000 in their TSP. Now, they watched their balance drop in March and then again in early April with the tariff announcements, and they're kind of done wondering when the next hit's gonna come, okay? So we roll the $200,000 into a market-protected accumulation strategy. It's tax-deferred, so there's no taxes due on the rollover. And the management fees that they were paying inside their TSP adjacent brokerage, okay, even though they were low, those fees are gone. And they receive an upfront premium bonus, and their money now participates in index-level growth with full downside protection. So if March 2026 happens again next year, their balance doesn't drop a dime. And if 2008 happens again, the balance doesn't drop. Their worst year is a flat year. It's never a loss year. Now, based on historical return assumptions, that $200,000 is projected to grow to approximately $600,000 by age 55. And not from extraordinary gains, but from uninterrupted compounding. There's no crashes to recover from, so no years lost in just rebuilding. And then at 55, we reposition the funds again into an income-focused strategy, and another bonus applies, and guaranteed compounding on the income base begins. Now, by 65, their income base exceeds $1.2 million, and they turn on retirement income at over $93,000 per year for life. Both spouses covered, so no market crash can reduce that income by a single dollar. Now, with 20 years in the TSP, their $200,000 may have grown to around $1 million if the markets cooperate, but under the 4% rule, that would have only produced about $40,000 a year with the constant fear of the next drop. But under this structure, $93,000 per year guaranteed and protected. And now let's talk about the scenario that should concern every veteran that's close to retirement. So let's say we have a couple age 62, okay? They got $500,000 maybe combined across some old 401ks, a TSP, maybe some IRAs. Okay, they got a military pension, VA compensation, Social Security, it's all flowing, okay? So they don't really need their savings right now, but they will soon. So right now, that $500,000 is sitting in the same structure that dropped in March, so it's fully exposed. And if the next crash is bigger, which history says it will be eventually, then they could lose $100,000 or $150,000 or even more than that, okay? And at 62, there is no time to recover from that. So instead, we move the $500,000 into a tax-deferred, market-protected structure, and they get guaranteed 8% annual compounding on their income base with full downside protection. So no market crash, not the next one, not the one after that, none of them can touch their principal. So let's say they delay income until age 67, okay? Partly to let the guaranteed compounding work, and partly to avoid triggering IRMA, which would basically increase their Medicare premiums. Well, now at 67, their income base has grown to over $730,000 and they turn on income. And it's approximately $55,000 per year and it's guaranteed for life. So both spouses covered for as long as either one's alive. Now under the 4% rule with their $500,000 still in the TSP, their balance might have grown to produce around $32,000 a year. And then they spend every March watching the news wondering if this is going to be the year that the big drop happens or that it's bad enough to change their retirement. But under this structure, March just doesn't matter. And neither does April, okay? The next 2008 doesn't matter because their income is contractually guaranteed. So here's what I want you to think about, okay? The TSP dropped in March of 2026. It's dropped before. It will drop again. That's not a prediction. It's the documented history of every market-based retirement account in existence. And every time it drops, the same cycle plays out, okay? Veterans panic, they check their balances, they call their advisors, the advisors say stay the course, the market eventually recovers, everyone exhales, and nothing changes. Until the drop happens at the wrong time. When you're, let's say, 58 and you're about to retire, or you're 65 and you're already withdrawing and the recovery doesn't come fast enough. Then everything changes permanently. The veterans I work with decided to break that cycle. They moved their retirement savings out of a structure that crashes every few years and into one that's protected by design. They didn't time the market, they didn't predict the crash, they just decided that the next time the market drops, their money would not be in it. Look, that decision was available before March of 26. It was available before 2022, even before 2008, and it's available right now. The only question is whether you make it before the next drop or after. So here's what I want you to do. Just click the link below and book a free strategy session with me. There's no cost to you, okay? There's no obligation. And on that call, I'll pull up your specific situation. So what you have in the TSP or a 401k or your IRAs, and I'll show you two things. First, what happens to your current savings in the next market crash? So not a percentage, but an actual dollar amount. And when you see that number, you'll understand why the 4% rule exists and why it's not even enough. And second, what happens when we move those same savings into a market-protected structure? So the projected growth, the guaranteed income, the protection, side by side, your money exposed versus your money protected. Look, you've already watched your TSP drop in 22 and then again in 26, so you already know how it feels. The question is whether you want to feel it again or whether you're ready to make sure that the next crash is something you read about in the news instead of something you experience in your account. So just click below, pick a time. Let's look at your numbers together. I'm Dan Farnsworth, Victory X Financial. Stay sharp, stay ready.